Hello, I'm Tess Downing, founder of Complete View Financial, and welcome to my March video blog post. Wow, what a couple of weeks it has been. I'm not really even sure where to begin, but first I hope you're staying healthy and staying home and staying protected. I wanted to make this March video blog post all about really how we're feeling and how that can impact the decisions we're making in our portfolio. So I'm going to address what has happened in past markets and how we might be able to apply that to this current situation, which is really nothing we've ever really expected before. So I'd like to hit on 3 different points and show you a couple of visuals that'll hopefully help us all feel a little more rational and take some of the emotions out of what we're experiencing right now with our markets and the portfolios that we have. So first visual, to begin with a little bit of humor, is illustrating exactly what we should not do right now when it comes to reacting to the markets and the volatility in the markets. We must focus on what we can control. We definitely know that we have no control over other people's behavior around the spreading of this virus, nor do we have any control on how the market responds to the federal government stimulus package. So this visual is a great representation on things that matter, things that you can control, and what we need to focus on right now. So here are a few of my thoughts. Number 1, the stress of being out of the market can be just as great as the stress of being in the market. Many investors may feel some form of stress or anxiety when their portfolios are declining. However, moving to cash and watching markets increase in value may cause investors just as much anxiety. The hard part about this is that those returns have already taken place and the investors will not be able to recuperate that missed opportunity. Number 2, as you know, we do not believe in timing the markets. To successfully time the market, you have to make 2 decisions right: when to get out of the market and when to get back into the market. This chart illustrates what can happen to your portfolio performance by missing 1 to 25 of the best days in the market. If you miss the 5 best days, your performance drops from 9.29% to 7.75% by just missing 5 days. We also know that historically speaking, some of the best performance typically takes place right after some of the worst down markets. The next chart is a great reminder of the market's response to crisis periods in the markets. We have September 1998, the Asian contagion. We have the September 2001 terrorist attacks, and obviously the most recent being the Great Recession in September of 2008. So you can see this is after cumulative returns after 1, after 3, and 5-year periods. Now the 5-year cumulative total return period in most cases is well above 40%. So to repeat, market timing requires accurately predicting when markets will decline and then when markets will rise. However, at any point, we believe that the market has already priced in all available information. New information can move prices, but research shows that it can be difficult to reliably predict what the new information will be. Making 1 prediction can be challenging, but making 2 is even more hard. In addition, investors must not only make a prediction about future information, but also predict how the market will react to the new information. Combined, all these factors make consistently timing the market very challenging. Number 3. And I would like to end on a positive note. In many great markets, the average returns on a following new market high versus a 10% or greater market decline are similar, which is very interesting. This chart shows a history of the market ups and downs from the S&P 500 total returns in US dollars from January 1926 to December 2019. History suggests that markets hitting new highs or experiencing declines provides little evidence of future returns. Looking at the S&P 500 index from 1926 to 2018, we find that the average annualized returns have been positive over 1, 3, and 5-year periods following both new monthly highs and market declines of at least 10%. This next chart shows the 1 and 3 year returns for the S&P 500 look similar after both market highs and declines of 10%. So in this data, we also see that the average return following a new market high is close to the average return after all other months, not just a decline of 10% or more. So understandably, most people are anxious right now about what will happen. We don't know where the coronavirus pandemic will take us. We don't know how the market will respond to the current news of the federal government stimulus taking place. So you might be feeling anxious about downward markets, or you might even be feeling a little optimistic, understanding that this might be a great buying opportunity. So whatever it is, please know that I am here and available and happy to answer questions and have one-on-one conversations with whatever questions that you might have. Thanks for joining in and listening to this month's March video blog.